In 1965, there was a factory worker in Dayton, Ohio. He woke up at 5:30 in the morning. He put bread on the table. His wife didn't work. She didn't need to. In 1965, you could buy a house on a single income. In 2024, you can't even do it on two. That man bought the house that sells for $289,000 today for $14,000. Now there's you. 2026. Same city. Same responsibilities. But to buy that house, you need to earn $90,000 a year. What do you earn? Let me tell you something. This is not your fault. And this isn't just an inflation issue either. This is a system whose long-term effects many people don't fully see. Today I'm going to tell you exactly how it works. Because once you understand the mechanism, the numbers look different. Picture a scene in your mind. 1965. You're 28 years old. You work as a line supervisor at General Motors assembly plant in Dayton. You've been at the same job for 6 years. Last spring you bought a 3-bedroom house on Smithville Road for $14,000. Monthly payment, just $89. Your wife doesn't work. She doesn't need to. She's raising your children, and every month you put $40 in the bank at 4.5% interest. You're building something. At 55, the mortgage will be paid off. At 65, you'll retire. You'll receive a pension worth 70% of your salary. You'll own your home. You'll go fishing. You'll see your grandchildren. You did everything right. The system rewarded you. Now it's 2026. You're 28 again. You work as a logistics supervisor at an Amazon fulfillment center near Dayton. You earn $58,000 a year. Adjusted for inflation, that figure is less than what the factory worker made in 1965. Rent, $1,200 a month. Student debt, $23,000. Your savings account interest rate, 0.5%, well below inflation, so you're actually losing money. And that house? The same house on Smithville Road. It sold last year for $289,000. You did the math. With a standard mortgage, the monthly payment would be $2,200. That's 43% of your gross income. The old rule was 28%. To comfortably afford this house, you need to earn $90,000 a year. Same job, same city, same responsibilities. Your work ethic didn't change. Your education didn't. Your discipline didn't. Something else changed. Something structural. Some people will tell you, globalization, technology, automation. You didn't get enough education. You didn't adapt. These answers aren't entirely wrong, but they don't explain the system. They just list symptoms. Here's the real question. Over the last 50 years, median wages have barely moved. But the prices of things the middle class needs, housing, healthcare, education, childcare, rose by 300%, 400%, even 1,000%. When wages stay flat and prices explode, the math is simple. The middle class didn't fail. The math failed them. The question is, why did prices explode? In the early 18th century, an Irish-French economist named Richard Cantillon noticed something that still affects modern economies. When new money enters an economy, it doesn't distribute evenly. It enters through banks, financial institutions, and government channels. Those closest to the system receive this money first. When they spend it, prices haven't risen yet. They're using today's money at yesterday's prices. By the time the money reaches the ordinary worker, through wages, through the general circulation of currency, prices have already gone up. Wage adjustments often lag behind price adjustments, but pays the higher price first. Over time, asset owners tend to benefit more than wage earners. It seems like a small difference, but over decades it turns into devastation. Let's make it concrete with the 2008 crisis. The Federal Reserve created over $4 trillion in new money after the crisis. This is called quantitative easing. They didn't distribute this money to citizens. They bought bonds and mortgage-backed securities from banks and financial institutions. The liquidity entered financial markets before it reached the broader economy. What happened? It was predictable. Instead of flowing into the real economy, the money poured into asset markets. Stocks rose. Bonds rose. Real estate rose. From 2009 to 2021, the S&P 500 quadrupled. Who won? Stockholders, homeowners, those with access to cheap credit. The primary beneficiaries were asset holders, Who didn't win? The median wage worker. The young person trying to buy their first home. Those saving at 0.1% interest, while inflation ran at 2 to 3%. This isn't an opinion. It's written in the Federal Reserve's own distributional data. In 2010, the wealthiest 10% owned 67% of all household wealth. By 2023, that figure had risen to 77%. The bottom 50%, half the country, owned 2.6% of total wealth. Pause for a moment. Half the country owns less than 3% of the wealth. This shift cannot be explained by individual behavior alone. The structure of monetary expansion tended to favor asset prices over wage growth. The Federal Reserve officially targets 2% annual inflation. You hear this in news bulletins, in statements, but no one says this in plain language. 2% annual inflation cuts money's purchasing power in half in 35 years. You're 30 today and you put $10,000 in the bank. At 65, that money, if it earned nothing, buys what $5,000 buys today. But I'm earning interest, you say. True. But for most of the last 15 years, savings account rates were below inflation. You weren't earning. Slowly, at a pace imperceptible year to year, you were losing. Economists call this financial repression. Savers are penalized. Borrowers are rewarded. So who has access to cheap debt? Banks, corporations, private equity funds, wealthy individuals with collateral. Who doesn't? The person who did everything they were told. Spend less, save more, be patient. The economic environment changed, but the advice did not. Late Roman Empire, endless military spending. Instead of raising taxes, the currency was debased. The silver content of the denarius, Rome's standard silver coin, was over 90% in the 1st century. By the 3rd century, it had fallen below 5%. What happened? Prices exploded. But not evenly. Those closest to the new money, government officials, military contractors, connected merchants, spent it first. By the time ordinary workers' wages caught up with prices, it was already too late. The Roman middle class, small farmers, craftsmen, shopkeepers, was slowly crushed. They sold their land to large estate owners. They fell into debt. This was not a moral failure, it was monetary mathematics. In Weimar Germany, the same mechanism worked faster. Workers paid in the morning spent their wages by noon, because by evening their money bought less. The middle class was wiped out. But those who owned factories, land, and commodities preserved their wealth, and often expanded it by buying up the distressed assets of the ruined middle class. The cycle is the same, always. In 1971, Nixon ended the convertibility of the dollar to gold. Since then, the U.S. money supply has increased by 4,000%. The median home price has gone from $24,000 to over $400,000. The real wage of the median male worker has risen by less than 5%. The correlation is difficult to ignore. The money supply expanded, asset prices followed, wages didn't. This is the Cantillon Effect operating over decades. Now we come to the most uncomfortable part. Reversing these dynamics would be economically complex and politically difficult, because it has created its own trap. U.S. federal debt exceeds $34 trillion. At current interest rates, annual interest payments are approaching $1 trillion, more than the defense budget. If interest rates return to historical norms, 5 to 6%, a large portion of the federal budget would go solely to interest payments. The private sector is in the same trap. Corporations took on trillions in cheap debt. Households carry over $17 trillion in mortgage debt. The entire system is built on the assumption that money will remain cheap. If rates rise, the system seizes up. If rates stay low, the mechanism keeps running. Asset prices inflate. Wages fall behind. The middle class erodes. Any adjustment would likely involve trade-offs. Historically, the Federal Reserve has tended to prioritize financial stability in times of stress. In 2019, it tried to raise rates. Markets wobbled. By 2020, rates were back at zero. In 2023, it raised rates to fight inflation. By 2024, it was already signaling cuts before inflation had even reached target. The cycle is clear. Numbers tell part of the story, but they can't tell the story of the 34-year-old nurse working 2 jobs who still can't afford a home in the city where she was born. They can't tell the story of the teacher who did everything right. College degree, stable career, 20 years of service. But who will retire with a 401k that won't last 15 years? They can't tell the story of the young couple forced to choose between owning a home and having children. Birth rates are falling across the developed world. Not because people don't want children, surveys say otherwise, but because the math doesn't work. The housing math doesn't work. The child care math doesn't work. The single income math doesn't work. This isn't laziness. This is arithmetic. And here's the cruelest part. The people caught in the trap usually blame themselves. I should have saved more. I should have worked harder. I should have made better decisions. They don't realize the rules of the game changed mid-play. During the pandemic, the Federal Reserve expanded its balance sheet by over $4 trillion in roughly 2 years. The money supply entered its fastest growth period in modern history. Asset prices surged. In many markets, home prices rose by 40%. Stock markets hit all-time highs. Then came inflation. For the first time in decades, food, gas, rent, the prices ordinary people pay rose visibly. 7%, 8%, 9%. This wasn't new. What was new was that it could no longer be ignored. For years, official inflation metrics didn't reflect reality. Housing costs were measured through a calculation that systematically lagged actual price increases. Healthcare and education costs were adjusted for quality improvements that meant little to the person writing the check. But by 2022, even the official numbers couldn't hide it. Here's the question I want you to sit with. If the structure of the monetary system tends to increase asset concentration over time, what is the point of telling young people to work hard and save? The old formula, education, job, savings, home, retirement, was designed for a monetary system that no longer exists. That system where real interest rates were positive, where wages grew with productivity, where asset prices were tied to income rather than liquidity, ended in 1971. But the advice didn't change. We keep handing people a map to a city that was demolished 50 years ago. In the current system, the single most important financial decision you can make is not how hard you work or how much you save. It's when you acquire assets. Those who bought homes in 2012 were rewarded. Those who waited until 2022 were punished. The difference wasn't discipline. It was timing and access to cheap credit. This isn't meritocracy. These are unequal starting conditions. Let's return to Dayton, Ohio. That house on Smithville Road is still there. The neighborhood has changed. The factory closed in 2008. The new jobs pay less. The new workers rent. The wealth that generation built, pensions, home equity, security, has largely changed hands. Some went to healthcare costs in the final years of life. Some to financial products that promised safety but delivered fees. Some simply eroded year by year silently in savings accounts that couldn't keep pace with inflation. The next generation started from further behind, and the one after that further still. This is not a failure of individuals. This is a failure of the system. The system is operating according to its structural incentives. It's just that over time it has become clearer who benefits most from its current structure. Will it change? History offers us two examples: significant reform, or continued gradual adjustment over time. Some societies reformed their monetary systems before collapse. Most didn't. What happens next will be determined not by economics alone, but by politics, by awareness, and by whether enough people come to understand the mechanism before it's too late. And the mechanism is beginning to become visible. Young people especially are looking at the math. Why can't I afford what my parents could afford? Why does everything cost more, but my paycheck doesn't keep up? Why does the stock market go up while my life gets harder? When economic patterns become widely discussed, they often influence public debate. This content is an educational analysis of monetary history and its consequences. It is not investment advice. Understanding how systems fail is the first step to surviving them. If someone watching this video is still blaming themselves, many people were navigating an environment that changed in ways they didn't fully see,